How does call risk impact bond investors? Imagine buying a bond expecting steady income 4 years, only to find out the issuer can call it back early. That's what call risk is all about. When companies or governments issue bonds, they promise to pay fixed interest over a set period. But if the bond is callable, the issuer has the right to repay the bond before the scheduled date. This usually happens when interest rates drop. Why? Because the issuer can refinance their debt at a lower cost by issuing new bonds with lower interest rates. For investors, this means they might lose out on the higher interest payments they expected for the full term. When a bond is called early, investors get their principal back sooner than planned. But they also face reinvestment risk. That's the chance they will have to reinvest that money at lower interest rates, which means less income. To make up for this extra risk, callable bonds often offer higher initial yields compared to bonds that cannot be called. This higher yield is meant to compensate investors for the possibility of early redemption. Call risk also limits how much a bond's price can go up. When interest rates fall, bond prices usually rise. But if the bond is callable, the issuer might call it to refinance at the lower rates. Investors then know they won't see the bond's price rise beyond a certain point because the issuer will likely call it once it's profitable for them. Many callable bonds include a call protection period. During this time, the issuer cannot call the bond, giving investors some certainty of receiving interest payments. After this period, the issuer can call the bond at specific dates and prices, which are detailed in the bond's terms. For adults planning their investments, understanding call risk is very important. If you're relying on steady income from bonds, callable bonds can introduce some uncertainty. They might be called early, which means you get your principal back sooner and need to find new investments. But if you're comfortable with some risk for higher yields, callable bonds can be a good choice. Always review the bond's call provisions, including call dates, prices, and any premiums, to see how call risk might affect your returns. In simple terms, call risk impacts bond investors by making their future income less predictable. It also exposes them to the risk of reinvesting at lower rates and caps how much the bond's price can increase. Because of these factors, callable bonds usually offer higher yields to attract investors willing to accept these risks. When including callable bonds in your investment plan, weigh the potential for higher income against the chance of early redemption and the need to reinvest at lower rates.